conversant with DCSL. DCSL is a leading provider of corporate services, including governance, legal advisory, company secretarial, training, and other services in Nigeria. We are based in our headquarters in Lagos with an operational office in Abuja. So basically to run through the services that we provide. So we provide bespoke training for directors and senior management. So we assist companies to upskill their directors and senior management staff. In that wise, to also provide induction services. You know, we also assist, provide retreat and strategy sessions services. We assist companies to organize the retreat and strategy sessions. And we also conduct what we call board evaluation and peer review. So the different codes of corporate governance require companies to conduct board assessment, board appraisal every year. We also provide that service. And then we assist companies to codify their board and committee charters. We have a legal arm which provides business advisory, legal and regulatory compliance services to companies in Nigeria. That arm also undertakes business recovery and insolvency services, and also setting up of companies. We also provide company secretarial services. We have a very rich portfolio of companies that will service as their company secretaries. And of course, we have the training unit, which is Christian DCSL Academy, through which we provide training services to companies, to directors, to employees. So that is a brief overview of the services we provide, and I hope that we'll be transacting business with some of you in the nearest future. So to go to the meat of the matter, by way of introduction, I'm Ozochi Nedu. I'm the head of Immigration and Legal Advisory Services at DCSL Corporate Services Limited, and I'll be the moderator for today's webinar, and also the middleman between you, our distinguished audience, and our guest facilitator. So some of the attendees will be wondering what informed the choice of the topic for this webinar. You know, particularly at this time when issues around the recently passed petroleum industry bill that was recently assented to by the president is trending. Well, the fact remains that Nigeria and indeed the whole world is still trying to combat the pandemic occasioned by the COVID-19, and the challenges it brought upon us, considering the changes, the way it changed our lives, the way we do things in our families, workplaces, and even at the national and international stage. So you will basically recall that in response to the pandemic, various states and national governments issued directives and policies. All of these were aimed at reducing the impact of the pandemic on the citizens and businesses. The Nigerian government was not left behind, you know, as it also tried to put in place policies and guidelines, including imposition of travel restrictions, visa limits, testing and quarantine directives, amongst other initiatives. So while the whole world was, you know, battling the corona pandemic, the federal and state governments had intervened, you know, by introducing targeted measures to stabilize the economy and restrict movement in order to control the further spread of the virus. For example, the Federal Executive Council approved the 2.3 trillion stimulus recommended by the Nigerian Economic Sustainability Plan to support the Nigerian economy in the face of the disruptions and challenges occasioned by the COVID-19 pandemic. It also approved other palliatives to cushion the effect of the pandemic. So through the primary tax agency, which is the Federal Land Revenue Service, the federal government particularly introduced some tax incentives to respond to the harsh economic condition experienced by Nigerians and businesses. One of such incentives has to do with the waiver of penalties on late returns, you know, for taxpayers who paid early and filed later, and also in times of remittance of VAT on or before 21st of every month, which was extended to the last day of the month. Also, in respect of tax audits too, I will recall that at the point the FIRS had to suspend audits and investigations and monitoring visits up until June 2020, and also declared that interest and penalties on additional tax liabilities which arose out of debt reviews will be waived. So these incentives were all aimed at attracting investment, increasing employment, raising capital, increasing economic growth, and most importantly, decimating inflation, which is seen by many as also a form of taxation. It is particularly important to note that regardless of these fiscal incentives put in place by the government, the government had also in place general travel bans initially and then selectively to protect the citizens. With the travel bans and the unprecedented disruption in global and economic activities, taxpayers became somewhat unclear about the status, the existence, and the extent of their tax liabilities, particularly as it relates to expatriates, most of whom were either trapped in the country or were unable to enter the country due to travel restrictions. So this webinar seeks to address some of these issues alongside providing clear answers to some of the inquiries of Nigerian taxpayers regarding residence and other tax obligations since the outbreak of the coronavirus. So this clarity is particularly required because, as Maria Carrier we know, the popular musician puts it, two things are permanent: rain and tax. So regardless of the prevailing situations and changes occasioned by the pandemic, issues around tax can hardly be set aside, given the importance to the nation's social and economic development. This webinar will cover the following key issues on expatriate residency and expatriate taxation in Nigeria. We shall be looking at the criteria for determining residency under extant Nigerian tax laws. We'll be looking at taxation of persons that are resident in Nigeria, taxation of corporate entities under the Nigerian tax regime, expatriate jurisdiction during tax travels, and other trending and issues on taxation in Nigeria. So let us note that these issues that we have highlighted merely serves as a guide to the germane areas that will be covered in the course of this webinar. And the presentation will not be limited to the aforementioned areas. Today on the webinar, we have a distinguished subject matter expert, Dr. Dick Uri. He's the Coordinating Director, Compliance Support Group, Federal Inland Revenue Service. Dr. Dick's career with the FIRS has been long and industrious. For over 2 decades, he has utilized his expertise in strategic planning, analysis, and risk management to benefit FIRS and his core mandate. He was appointed Deputy Director, Technical Domestic Tax Group in 1997, and in September 2018, he was assigned to his present role as the Coordinating Director of the Compliance Support Group. Doctor is a member of the Institute of Chartered Accountants of Nigeria and he holds a bachelor's degree in accounting and finance from the University of Derby and an MBA in financial management from Akintola Adegoke University of Technology. Doctor also holds 2 postgraduate degrees, an MSc in public sector accounting and a PhD in accounting from the National State University. Joining us today also and to deepen the discussion and attend to our queries during the Q&A section, Mr. Kehinde Kayesomo, the head of International Tax Policy Division of the Tax Policy and Advisory Department of the Federal Inland Revenue Service, and Mr. Abdullahi Aliyu, the tax consultant at the Non-Resident Persons Tax Office, both of whom are with us today. Before I invite Dr. Uri to dissect the subject of today's webinar, I will urge the participants to ensure that this is an interactive session. We enjoin you to leave your comments and contributions in the chat box and the questions in the Q&A box. We hope that this webinar will be as interactive as possible because we know we have the right person to dissect the topic of today's discourse. So I now invite Dr. Uri to present his paper. Thank you.
Good morning, Chinedu. Good morning, Nike Taiwo. Good morning, my colleague, Kainde and Abdullahi. Good morning, everyone on this webinar. Let me just correct our moderator. Abdullahi Aliu is the tax controller of the non-resident persons tax office of Federal Revenue Service in Ikoyi in Lagos State. Is the tax controller. They are here, they are the experts, and I'm on policy level in FRS. We regard this opportunity as an avenue for FRS to further deepen engagement with taxpayers all over the world, especially Nigeria, the country. So for us, as we speak on this topic today, expatriate transition in Nigeria, determining residency of an expatriate during the travel restriction period, we are offering this as an opportunity to educate the public. So by way of introduction. Now going to the subject matter today, there's an outline to the paper which I mean now they may display for us to see. There's an outline which covers introduction. The next page. Outline covers introduction. The next page, introduction, concept of residence. That's the outline that we're going to go through this morning. And no need to mention that. But let me just take us straight to the introduction. Here we are looking at two things. There's the immigration regulation, and there's also the tax law and practice, which we are going to speak to. So we need to take note that these two are the major related legal framework or document that we need to work with when we talk about expatriate transition in Nigeria. So to us, I'll be discussing the residency rule and the basis of taxing individual or companies in Nigeria, which are non-resident in particular. So for by way of definition, I'm the third slide now. By way of definition, immigration law has their own interpretation or yardstick for measuring, determining who's an expatriate. Under immigration law, a resident means a person entering and remaining. I've gone to the third slide now. Who is coordinating? Is it Chinedu or Taiwo? On the third slide now. The concept of residence is what I'm speaking through now. I'm looking at it on two bases now. The immigration law dimension, how a resident is regarded in Nigeria. For immigration, it says that the resident must have stayed or remain in Nigeria for at least 90 days or more. But in the tax law, the definition of who is a resident differs slightly. Here, the tax law requires that the tax law requires that the individual or the expatriate must have lived in Nigeria for a period and added together not less than 183 days and above in a 12-month period. That is looking at a year. If an expatriate have lived for 183 days in Nigeria, is regarded as a resident. So now, what exactly are we looking at? We are looking at, I want to take us through two basic residents. Now, the residents and non-residents, so to say, concept of resident that has two dimensions in the tax law. The resident and non-resident. For residents, there are basically three things that we need to look at. One, the person must be domiciled in Nigeria. Domicile means he has a living place in Nigeria, ordinarily known to be his place of residence. Or two, a sojourn in Nigeria for a period of 183 days. Sojourn means the person who has a temporary place of stay in Nigeria for that period. That's what it simply means. Then the third person that we regard as resident, somebody who's serving as a diplomat or diplomatic agent of Nigeria in a country other than Nigeria. That is, all the diplomatic employee of Nigeria serving other countries are regarded as Nigerian residents. While non-residents, we look at two things. One, the individual who have lived in Nigeria for a period not less than 183 days, or a resident company which is registered, who has jurisdiction in Nigeria, who's registered in Nigeria by Nigeria context is the Corporate Affairs Commission. Any company registered by Corporate Affairs Commission in Nigeria is a resident company in Nigeria. So the expatriate transition, we are going to look at three different dimensions: the resident, the non-resident. Expatriate can fall into the category of being a resident, it can fall into the category of being a non-resident, or it can have a dual residency nature. I've spoken about residency, which is the domicile, the temporary stay, or the Nigerian Nigerian diplomats working in other countries employed by Nigeria. The non-resident is someone who is not ordinarily a citizen of Nigeria, who didn't have this criteria, but have lived in Nigeria for a period not less than 183 days. You are not resident, but once you satisfy this condition of 183 days, you automatically transmit to a resident individual. An expatriate will have dual residency identity. That is, you are a resident at the same time non-resident. In this case, the individual is treated as a resident in two tax jurisdictions. That is, his income could be taxed in Nigeria, could also be taxed in his state of country of origin. So now, what happens when an expatriate has dual residency? I'm going to take us through in the course of this discourse and explain how this is treated in taxation. Now, basically, when we talk about expatriate, it could derive income in three ways. One, it could derive income from business. It could derive income from employment. It could derive income from passive sources. Passive sources are the investment that he or she has made that gives him returns like rent, dividend, royalty, or interest. When you place money on fixed deposit, for example, you earn interest. When you have property, you earn rent from it. When you invest in company, you earn dividends. So these are passive income that are not coming from the direct endeavor that individual or company is engaging. Employment comprises all the income that's accruable to that individual as a result of his personal service or effort that he put into generating that source of income. While business, as it is, just talks about the gain or the profit that the person earned from his business endeavor. So these are the three basic sources of income that an individual or a company can earn income from that is subject to tax in Nigeria. So non-resident, how is non-resident subject to tax in Nigeria? Now, for a non-resident to become liable it becomes liable if you are into business, it becomes liable from the very day that it commences the business. And the very day it commences business or a vocation or profession in Nigeria, the income generated from that business become liable in Nigeria. That is the source, what they call source income. While in employment, if either the person resides in Nigeria and is paid emolument, as I described earlier, cumulatively for a period of over 103 days, or the employer becomes a factor here. If the employer is in Nigeria, the employer of that individual is in Nigeria, then that person's income is subject to Nigerian tax. On the other hand, the employer of that individual could be any of the government in Nigeria. And of course, in Nigeria, you know that we run three tiers of government. We have the federal government, we have the state government, we have the local government. If any of these state 3 tiers of government employs you in Nigeria, and you are working for any of these 3 tiers of government, your income is subject to taxation in Nigeria. On the other hand, you could also be those that work on narrow bordered areas. This like those that on ship, they call them seafarers, or performing some work on boarding a ship that are into distant territory in the water area. That is there's in international taxation. We have this dimension of water depth that is covered as territory that are beyond the states or federal in terms of determining jurisdiction of taxation. Now, the duality, the next stage is how do we now handle the dual resident individual tax liability in Nigeria? An expatriate that is resident in Nigeria and also resident in another country, how do we handle their income? Ordinarily, looking at it from the point of view of the tax law, the global income or the worldwide income of an individual is what is subject to tax in Nigeria. Now, if an expatriate fall into this category of dual residency, the law will take his worldwide income and subject them to tax. However, because you have dual residency, and especially when that country has a treaty agreement or status with Nigeria, then the individual will be given credit when the income is being subject to tax in his home country. He will not be given credit for the tax that he has paid in the source country. The source country here is Nigeria. It's an expatriate. He has earned income in Nigeria, but because his own country has a double taxation, avoidance double taxation agreement with Nigeria, the income that have been subject to tax in Nigeria will not be given a credit in that country, so that it won't suffer double taxation on that income. It won't suffer double taxation on that income. So this is what we need to take note. And I take us to the implication of double taxation in Nigeria. Here we are. Now, we have double taxation between Nigeria and the home country of the non-resident expatriate. The following rules applies. For employment, the total emolument of that expatriate from employment in Nigeria is taxable in Nigeria. If the employment is exercised in Nigeria, having within a period of more than 183 days, as I said earlier, if the remuneration is paid by a Nigerian employer on behalf of the Nigerian employee, or the remuneration is borne by the permanent establishment of a fixed base. A fixed base here is that the company that employed that expatriate has a place of business in Nigeria. And there are about 4 rules, which I will leave to Kehinde to expatiate on later. Because of time, I'll leave him to expatiate that later as you will continue the discourse. There are about 4 to determine the fees base in Nigeria. And of course, let me just quickly add up front here that in the Finance Act of 2019, the Nigerian government have introduced what they call a significant economic presence. And this relates to these online businesses that happens. And we want to see how all these online businesses, how can we bring their income to transition into tax in Nigeria. So the significant economic presence was introduced in the Finance Act. I will also leave that to Kehinde to expatiate further in the course of this discourse. Now, we need to take note that Nigeria have only signed a double taxation agreement with 15 countries so far. There are others than the drawing board. Some have gone far in the negotiation, but at least those that have been signed off and have been domesticated in Nigeria, we have 15 countries. And the countries are there: Canada, Belgium, Romania, United Kingdom, South Africa, Czech Republic, Pakistan, France, Netherlands, China, Philippines, Slovakia, South Korea, Sweden, and Spain. These are the countries that the Nigerian government have signed an agreement with. Now let's go to the main clause of the paper. All that I've given you so far is just the background. The main clause of the paper is that how is an expatriate subject to tax in this period of pandemic where we have travel restrictions. Some may not be caused by them. Some may be as a result of the COVID restriction. You travel for maybe for a short while. By reason of lockdown of the country, of business activity or movement, you just find yourself trapped in that country. You're unable to return to your home country. How are you supposed to be treated in tax in Nigeria? Ordinarily, from what I told you, and also OECD Article 15(2)(a), the determination of residency is the 183 days stay in a particular year in a country put together. However, by reason of this emergence of the COVID-19 and restriction of movement, 3 basic rules have been adopted all over the world, especially countries that belong to OECD. 3 basic rules have been adopted. 1 is that person no longer working in Nigeria. If it's no longer working in Nigeria, that fact will be taken note of. 2, was that person prevented from leaving Nigeria due to COVID-19 restriction, for example? If that is the case, that fact will also be taken care of, be considered when talking about his tax liability. And lastly, ordinarily, would that person have left Nigeria before 183 days? These basic 3 rules are what OECD have put in place that most countries have adopted, including Nigeria, in treating the issue of taxation of expatriates as occasioned by this COVID-19 movement restriction. So expatriates under domestic law, that's domestic law, we talk of Nigerian law now. It simply means that anyone who derives income from Nigeria is taxable on that income from day one, whether or not he is resident in Nigeria. You know, ordinarily. It follows, therefore, that the days of presence rule illustrated above are not applicable to expatriates from countries with whom Nigeria has tax treaty, because here I said if there's tax treaty, and I've already shown you that Nigeria have signed 15 treaties with 15 countries. So if there are tax treaties, the tax you paid here will serve as credits in your home country when you go back to your country. And that income is to be subject to tax in your country. The tax that the income have suffered in your source country become credits to you in your home country. Now, one thing that is also very important, because not only individuals that fall into the category of non-resident, we also have corporate entities that fall into the category of non-resident and resident. And here we call them Nigerian company and non-Nigerian company. Nigerian company ordinarily, what it simply means, every company that is incorporated or registered by Corporate Affairs Commission in Nigeria, or any other authority that government have given power to register businesses or entity to do business in Nigeria. And of course, you know, cooperative, though they are not into commercial activity, they are registered by the state. They can also do some business among themselves. I will also have some NGO that are also registered by Trade of Ministry of Commerce and Industry and the rest. They can also do business in Nigeria. But any company that registered in Nigeria become a Nigerian company, and that which registered by another country other than a Nigerian company is a non-Nigerian company. Now, profits of non-resident company accruing in Nigeria. We have these are the basis for determining whether a company income should be taxed in Nigeria. One, profit attributable to the fixed base. Fixed base is where you are known to be doing business in Nigeria, or you embark on a single contract for survey, delivery, or installation, or construction business. They give a contract to do construction business. So that income is subject to tax in Nigeria. Or habitually operate business through an agent, somebody that you have control over. You determine it works for you actually. That income that comes from such activity is taxable in Nigeria. Or you are involved in providing some technical and management consultancy. Of course, this one, that's where special economic presence comes in. And withholding tax can also be paid on such income before the money is remitted to you abroad. The electronic digital activity, as I said, this one came in with the Finance Act 2019 to be able to track e-commerce and electronic presence in Nigeria, like all these social media that you all know the drama around Twitter and the rest, making them to register now with Nigerian government and the rest. So this, then the next thing that comes to mind is that an expatriate have earned income in Nigeria. How does he repatriate his fund to his country of origin or stay abroad? This is simple. As remittance of fund out of Nigeria. What the government of Nigeria expects from you is that income must have, if it was earned in Nigeria, must have been subject to Nigerian tax. And simply, most of them, especially this consultancy, technical fee, management fee, they should be subject to withholding tax before they are remitted to your home country. And what the government of Nigeria expects from you is to obtain tax clearance remittance certificate. That's what they expect from you. And they'll be subject to withholding tax. These are the normal rates that are displayed, but for countries where there are double taxation agreements, this rate, the rate that's applicable is slightly different. I think slightly lower, if not stated in the agreement, at least should be 7.5% of the fund that is being remitted. These rates, you are just to take note of them. They don't really apply to funds that are being remitted abroad. Ordinarily for income, investment income, as I said, which is passive income, it will be subject to 7.5% to 10%, depending on the agreement, what the agreement stipulates between the country where they have double taxation agreements. Otherwise, the normal rate will be applicable. If there's no double taxation agreement, this normal rate will be applicable to income generated that's being remitted abroad. Capital gain tax is another source of income, which is the gain that is derived from sale of assets. When the proceed is more than the cost of acquisition, a capital gain is realized, and that one is flat rate of 10% that is subject to tax in Nigeria. Now, federal revenue service, but for persons, residents, the next slide. Person, we have a resident individual, military, police, officers of foreign affairs. This police, military, officers of foreign affairs, those one fall under the federal tax authority of the Federal Revenue Service. The resident individual, the state of residence, become your tax authority that can tax the income of that individual. If an expatriate is resident in Ogun State, it's Ogun State tax authority that can tax the income. If the expatriate is resident in Lagos, Lagos State can tax the income of that individual. But if it's any individual that's in the military, police, or foreign affairs, it becomes the federal tax authority that can tax that individual. So foreign diplomats accredited to other country from a Nigerian diplomat accredited to other country, they are taxed by the Federal Inland Revenue Service. Whereas the diplomats that are accredited to Nigeria, they are taxed by their own home country tax authority, not Nigeria. So all the diplomats that are in Nigeria, by nature of diplomatic understanding, they are not subject to tax in Nigeria. The next thing you need to take note is the tax rate, the tax table that is applicable to individual income in Nigeria. It's ranged between 300,000 to 3.2 million, and the rate of 7%, between rate of 7% and 24%. That is the tax that's applicable to the individual. So on this note, I want to say thank you very much for listening, and I hand you over to my colleague, Kainde Kaje Somo, and Abdullahi Aliu. Abdullahi Aliu is the tax controller of non-resident persons tax office in Nigeria, in FRS, while Kainde is the head of international tax in the tax policy division of tax policy department of FRS. So I hope by this few slides I've gone through, I've been able to divulge some knowledge or educated you on some aspects that probably were not too clear to you. But I have these two experts with me, Aliu and Kainde, who will take on all your questions and explain further some of the areas that probably I just brushed through because of time. Thank you very much. It's a privilege to be here with you. Thank you. God bless.
Thank you very much. Thank you very much, Doctor, for that insightful presentation. For dissecting the tax laws as it applies to expatriates and the often controversial issue around residency. You did justice to the topic, and I'm sure the participants are now better informed on the applicable principles with respect to expatriates and residency. It is very, very important to note that this topic is quite germane, as expatriates had issues the aftermath of the lockdown to determine their residency due to travel restrictions and visa bans that was put in place by the government. And I'm happy that you have clearly provided valuable insights on how some of these issues will be treated. Of course, we'll have Aliu and Kainde to provide support and to respond to questions that the participants might have with respect to the topics. It's actually an opportunity, even if the question is on an area that is not outside this topic. Like the Igbo adage says, you don't climb the Iroko every day. If you climb it once, you have to gather all the fruits you want to. So we're happy that we'll have these gentlemen here with us today, and we'll try to distill all that we can from them, and so that by the time we go back to them again, to take some time. So Aliu and Kainde, we're happy to have you. And I don't know whether before we go into the question and answer proper, do you have anything to add to Dr. Yuri's presentation? We'll just take maybe a few minutes from Abdullahi and also Kainde before we now go to the question and answer proper. Aliu first, please.
Okay, good morning, ladies and gentlemen. While the presentation is concise, precise, and simple, I think I've covered a substantial part of it. I think we can go to the questions and answer, but let me just wait for my colleague to come in. Thank you.
Thank you, Abdullahi. Kainde?
Yeah, thank you. It's a wonderful presentation by Dr. Iri, and I agree entirely with everything that has been said in the presentation. But just as a summary to emphasize the two main issues regarding the core issues about COVID-19, is to emphasize the fact that we should know that when we talk of employment income, the condition for taxing employment income is the employment exercise in Nigeria. I mean, if it is a non-resident, if it's a non-resident, number one, the payment can be from a Nigerian company or a fixed base of a company in Nigeria. So if the payment is from a Nigerian company, for example, if I'm employed by your company, I want to believe your company is a Nigerian, DCSL Academy. I want to believe it's a Nigerian company. So if I'm employed by DCSL Academy, whether I work in Nigeria or not, wherever I work, as long as it's DCSL, a Nigerian company that has employed me, then any salary or any employment income I derive will be liable to tax in Nigeria. The second side of it is, now DCSL Academy is a foreign company. Assuming DCSL is a foreign company. Now, for me, non-resident, now assuming I'm a British, for me to be taxable in Nigeria, then I must exercise that employment of DCSL Academy in Nigeria. So two ways. Now, first one is DCSL a Nigerian company? If DCSL is a Nigerian company, wherever I am, as long as that Nigerian company is paying me, I'm liable to tax in Nigeria. The flip side of it, DCSL is not a Nigerian company, but I'm a non-resident, but I'm exercising the employment of DCSL in Nigeria. Then I'm also liable to tax in Nigeria. So, and that's where the COVID-19 issue comes from. So if, for example, DCSL is a non-Nigerian company and has sent me to Nigeria to work maybe for 30 days, and within that 30 days, a COVID issue came up and I couldn't travel. The question to now be asked is, yes, I'm in Nigeria and I'm liable to tax in Nigeria, as I've said, employment income from day one. So yes, I was sent to work in Nigeria for 30 days. Those 30 days, I am taxable. The income I derived from Nigeria. Now, I should have gone back, but because of COVID-19, I have not been able to go back. The next question is, am I still working in Nigeria? As long as I'm still working in Nigeria, I'm talking about under the domestic law now, as long as I continue to work in Nigeria, whether I'm not able to travel or able to travel because of COVID-19, but I am exercising employment in Nigeria, it's still covered. So whether COVID-19 restricts me from traveling or not, as long as I exercise that employment in Nigeria, I will still be liable to tax in Nigeria. So that's what I said I should just re-emphasize. Thank you.
All right, thank you very much, Kennedy, and for throwing more light on Dr. Iri's presentation. And I mean, it's clearer now. Participants are please kindly encouraged to drop their questions in the Q&A section. We'll try as much as possible to read out the questions and then have our experts attend to them as much as they can. Before we delve into questions from the participants, okay, some questions were sent in before this program, and I would like to read them out so that our experts can attend to them. Number one is says, considering the importance of expatriate taxation to the Nigerian government, are there specific provisions in the Personal Income Tax Act dedicated to the taxation of expatriates only? If not, don't you think this is necessary to address the confusion which often arises on expatriate taxation? That is number one question. You want to speak to that, sir?
Thank you. Is there any particular provision or section dedicated to expatriate taxation? Yes. No. The answer would be no. And the reason is that, as mentioned by the paper presenter, there are different rules covering different situations. there you have the issue of residents and we have the issue of non-residents. And it also determines what you classify as expatriates, because somebody can be in Nigeria for 1 year, and based on the immigration rule, it's still classified as expatriate. But to the tax law, that person is known to the tax law as a resident. And every provisions in the tax law regarding you and I that are Nigerians, we apply to such a person because he's for tax purpose, he's a resident of Nigeria. So it will now be difficult to start creating provisions, the different sections for such rule. And so yes, maybe for clarity, what we have done is to issue guidelines and circulars. We shouldn't forget also that it is the legislators that pass laws. The laws are made by the legislators. However, ours is to look at that law and extract those provisions that relate to each category of persons or business and so on. So what we have done is to have circulars. So you can visit our website. We have a circular dedicated purposely for non-resident. So we have a circular called Taxation of Non-Residents. So what we try to do using that circular is to look at all those provisions in the tax law and put them together and, where possible, explain them so that the expatriates know how to implement those provisions. And of course, they also know where those provisions are located in the tax law. Thank you.
Thank you very much.
In addition to my colleague and then the presentation, you have seen in the presentation that the presenter was able to make it and what my colleague have already said. But the question you are asking specifically, which provision in the PITA, that's personal income tax, that guided the taxation of individuals? Yeah, taxation of an expatriate, as we said, there is nothing like that in the whole entire tax. It's just a common usage. People are saying taxation of expatriate. Expatriate will either be a resident or non-resident. That is what is being provided in Personal Income Tax Act. They will either tax as a resident individual or as a non-resident individual. The whole entire Personal Income Tax PITA is dealing with the taxation of resident individual, except in Section 2, subsection 1B4. That's the one that specifically deals with taxation of non-resident. And then third schedule, paragraph 6 of the personal income tax defines that non-resident further. So these are the two places you find in the personal income tax because you have specific provision that deal with the taxation of non-resident, while the whole entire other part is dealing with the taxation of residents. So that's the additional clarification that I just want to put in. Thank you.
Yeah, thank you very much, Abdullahi, for that clarification. That's quite germane. So that takes me to the second question. Taxation is all about residency, you know, and expatriate taxation is just a coinage that's suitable to address particular issues. So how does how do you determine? Let me put it another way. So what do you mean by residency? Is it physical residency? Because we're looking at now, what is the implication of residency for expatriates working remotely, for example, outside Nigeria, but for Nigerian entities? How do you classify them?
Yeah, thank you. Expatriate working remotely, of course, we come under a non-resident. Now, whether it is being paid by Nigeria or non-Nigeria, as long as the person has not fulfilled the conditions of residency. And what are the conditions? The paper presenter mentioned them. Number one is that for you to be resident in Nigeria, you are domiciled in Nigeria. When we say domiciled in Nigeria, we mean you have a place of permanent abode in Nigeria, maybe a rented apartment or you built it yourself. And on a normal day, you can you can travel to Nigeria and go there and sleep, and it's available to you on a normal day, then you are a resident of Nigeria. And if you don't have such, then you are not a resident of Nigeria. The second criteria is you have stayed also joined Nigeria for 183 days in 12 months period. So if within a 12 months period you have stayed in Nigeria, then you are a resident. But if not, then you are not a resident. Then number 3 is, are you a diplomat of Nigeria? For example, if you work in the our foreign affairs and you are posted out of Nigeria and you have stayed out for 3 years, but as long as you are still working, you are still a diplomat of Nigeria, despite the fact that you are outside of Nigeria, you are still a resident of Nigeria. So if none of these 3 rules catch you, then you are a non-resident. So, and if you are a non-resident, can you still be liable to tax in Nigeria? As I said earlier, yes, it's still possible. So yes, you are a non-resident. How can you then be taxable in Nigeria? Number 1, if you derive passive income, for example, dividend is coming to you, interest is coming to you, or rent is coming to you, despite the fact that you are not in Nigeria, you are still liable to tax in Nigeria. Number 2, as I said earlier, is your employer in Nigeria. If your employer is in Nigeria, despite the fact that you are staying abroad, you have not come to Nigeria, you are a non-resident, you can still be liable to tax in Nigeria. Number 3 is, did you at any time, sorry, number 3, as I said earlier, is the fact that whether you are deriving a trade, income from a trade or business. For example, you are abroad, you provide a management service or consultancy service or any service whatsoever to Nigeria, despite the fact that when you are providing that service, maybe you provided it by email and you didn't come to Nigeria at all. But the fact that you earn such fees from Nigeria, you are also liable to tax in Nigeria. And another one is if you derive a gain. For example, you have a property in Nigeria and you sell that property, despite the fact that you have not come to Nigeria, you are liable to capital gain tax in Nigeria. It's because the property that you have sold is here in Nigeria. So those are instances where somebody that have not visited Nigeria or that is not in Nigeria can be, which is a non-resident, can also be liable to tax in Nigeria. Thank you.
Yeah. Thank you very much. Thank you very much for properly attending to that question. So, perhaps the third question is, has been taken care of, but I will still ask that question. Because I heard Dr. mention 183 days rule, and how it applies to residency and all that. So perhaps you have kind of touched it in your last response. But let me ask this question that was sent in. It says the Nigerian Immigration Act contains provisions for the issuance of temporary work permits to expatriates, which enable them to come into Nigeria on a short term to provide services. Considering the short tenure of the permits, some of which could be under 1 month, how does the FIRS ensure that such expatriates are covered under existing laws, particularly considering the 183 days rule? Maybe Abdullahi will assist us with that question.
Okay, thank you. The residency rule, based on the paper presentation, you have seen it that the residency rules differs from that of immigration and taxation purposes. Immigration considered for 90 days as a resident, while for tax purposes, generally what is being practiced globally all over the world mostly is 183 days. I think with the exception of US that is using as a citizen. So 183 days is general, that is one acceptable as a cutoff date. That's a cumulative number of days you stay in Nigeria or in a particular country in a 12-month period. So when you fulfill that criteria, you are considered for tax purposes to be a resident. So the general domestic laws of that jurisdiction should apply to you. But once you are staying less than 183 days, then you are just going to be subjected to tax based on source income, because the taxation of an individual, of a resident, is on global income, while that of non-resident should be on the source income, because you are going to be subjected to your tax in your own home country. So it's only the source income that you've gotten. That's what is going to be subjected to tax in Nigeria. So going back to that, the period that the question is asking, immigration used to have three commonly distinct. You have temporary work permit, which is 90 days, maybe renewed by another 90 days, okay? And after that one, you have to confirm whether they are going to be a permanent citizens. And there's another one which is, they call it subject to regularization, okay? Which is also they will give for the first 90 days and then you clear. These are all criteria of custom. And I think the general one which they give for those that are staying long are SEPAC. Okay, combined expatriate, permit, and island card. These are all the criteria that are general, that are the common one that immigration gives. But for us in FRS to have that information with immigration, we started that collaboration effort with Nigerian Immigration Services. So at least we have some of the information they have given us now for about 6 months for 2020. So we are trying to establish that we can be able to get instant exchange of information of those people coming into Nigeria as they are issuing the visas, they are passing information to FRS. And I think I know even the state internal revenue too, they're having that collaboration with immigration. So now solely is the collaboration of immigration services and then the taxing authorities of both federal and state, they will be able to get information of those expatriates coming into Nigeria, so that they will at least not be subjected to two kind of double tax by states and then the federal. For federal purposes, once from day one, we know you are staying more than 183 days, we don't have business with you. Go back to the state where you are domiciled, because 183 days considered a resident for tax purposes, you should be taxed there. But once you are less than 183 days, then FRS will take part of the taxation of it. I think that is clear. Chinedu, you can't hear you. Yeah.
Oh, sorry about that. I was on mute. So thank you very much. That's quite clear, very, very clear. So we'll have another, this next question. The gentleman or lady is looking for an expo, but I'll still ask the question though. We'll have the experts to determine whether they will provide answers to it. It says, aside from the double taxation agreement and other mentioned, are there other tips and tricks expatriates can take advantage of in computing their tax liability? Then in bracket, without evading tax. I don't know whether Kenya is able to respond to that.
Thank you. The provisions of the law is your entitlement. I mean, if there is an incentive or something that has been given to you in the law, then it's my duty to also inform you. So in that wise, as I said earlier, or as the paper presenter said, it's possible for you to be an expatriate and still be a resident of Nigeria. So if you are an expatriate and you are a resident of Nigeria, that means you are going to be liable to tax on your worldwide income. That means it's also possible that you are going to be taxed, or you may be taxed somewhere else, maybe your home country. Then what happens to you? Are you going to be taxed twice? Yes, you can say under the double taxation agreement, there's a provision to relieve double taxation. But under our domestic law, there's also provision to relieve you. So when you go to Section 11 of the Personal Income Tax Act, it allows a unilateral relief in the sense that that provision says if you are paying tax in Nigeria, your worldwide income, and that same income, you are paying tax on it in another place, that provision allows you to deduct that tax you have paid abroad from the one you are paying in Nigeria. So it's not the intention of the lawmaker to place burdens on people. The intention of the lawmaker is to ensure that you pay your fair share of tax in Nigeria. So if you are a single income, that income is taxable in Nigeria, and that same income is still going to be taxed somewhere else. Section 11 of the Personal Income Tax allows you to deduct the tax you have paid somewhere else from the tax that is payable in Nigeria. So it's
So thank you very much.
And a non-resident that are paid in Nigeria, some jurisdiction also has such unilateral measures in the sense that, for example, you didn't spend up to 90 the 3 days, so you are not a resident of Nigeria, but you have paid tax in Nigeria. If you get to your home country also, there are some provisions. I'm aware of US, for example. US, for example, has a provision that allows you to deduct that tax you have paid in Nigeria from the tax you are going to pay in US. Thank you.
Thank you very much. Thank you very much. So whoever asked that question, those are the tricks that actually your entitlement, and you can always claim them and utilize them in making your tax computations. The last question we have here was raised by David. It says, will a non-resident who also stays outside Nigeria, who provides remote services to a Nigerian company and is paid by a parent company of the Nigerian company that is based in a foreign company or in a foreign country, be liable to tax to the Nigerian government? I'll take that again, sir. Will a non-resident who provides remote services to a Nigerian company and is paid by a parent company of the Nigerian company that is based in a foreign country, will he be liable to pay tax to the Nigerian government? Abdullah, I don't know if you that is clear enough.
Well, I will make an attempt and then the policeman will clear it.
So you can read the question yourself. You can read the question yourself in the Q&A section. I guess you want to get more clarity.
Okay, well, another person who stay outside Nigeria.
Can I answer that then? No, are you? Let's apply that. Okay, you can. Please go ahead.
Okay.
Go ahead.
Okay, please go ahead. I'm just on provide some later.
Yeah. Yes. Just to understand the question properly, what we are saying here is that, for example, DCSL Academy has a parent company in US, and I am in the UK. I've provided a service to DCSL Academy, and DCSL Academy has said, oh, my parent company in US, please help me pay that service. There's no Father Christmas anywhere. Based on transfer pricing rule, that's DSL Academy in Nigeria is still going to pay for that service. So the parent company is just acting as agent for the purpose of paying that money. That bill, the expense is still coming to the books of DCSL Academy. Yes, DCSL Academy did not actually part with the cash, but of course, there's going to be a reimbursement when you are doing adjustment with your parent company, because that cost, it relates to DCSL Academy, and that cost is deductible as an expense from the business income of a DCSL. So in that wise, that deduction will still be made. The deduction is 10%. So when the parent company is paying on behalf of DCSL Academy, and the obligation of DCSL Academy in respect of deduction of 10% withholding tax will still be applicable. So when the parent company is making that payment, it is expected that that parent company will deduct the 10% withholding and remit to the Federal Inland Revenue Service. Why did I say, as I've said earlier, the parent company is just making that payment on behalf. It's not the one that is making the payment from his books. He's just doing it on behalf of the Nigerian company. And that cost is still coming back to the Nigerian company to be deducted from his books. So that's tax is payable in Nigeria, 10% withholding. Thank you.
Thank you very much.
It's part of the criteria. Yeah, it's part of the criteria that we have now for you to cast an employment income in Nigeria or anything. One of the conditions, if the non-resident have a fixed base or have office in Nigeria, that's one. Or if the cost is borne by the Nigerian fixed base. So that's what my colleague has explained, that eventually it will come back to Nigerian fixed base. So either you're asking your parent or whatever it is. I know The whole issue of taxation, cross-border transaction, is to avoid either to evade tax or to avoid being taxable. If you allow that kind of payment, not tax, the fixed base is being underpaid tax by the company income tax. Simply, let me make it clear. Because it's going to come as an expense. The expense will be an allowable expense. Ordinarily, if it is a Nigerian individual that render that services, you will subject him to personal income tax. But now, because of the tax planning, the kind of the structure they have done it in such a way that they want to convince you that it's not a payment that is coming to Nigeria, but eventually come to Nigeria. You will allow this an expense. That what you have allowed impliedly directly affect the company income tax of that fixed base. So which means they have avoided or evaded tax in Nigeria impliedly. So that's the reason. Once the fixed base is being suffered at the end of the day by reimbursement, of course, you're subject to tax in Nigeria. Thank you.
Thank you very much. Thank you very much. So the last question before we wrap up. It's centered around number one. Does the FRS have a minimum amount which it thinks an expatriate is deemed to earn in Nigeria, depending on the expatriate nationality and industry? Is there anything like that? Then number two, so what is the tax liability where none or insufficient tax has been paid by an expatriate? The question is twofold. So does the FRS, just thinking aloud, does the FRS have a minimum amount which an expatriate is deemed to earn, depending on the expatriate's nationality and industry? And then what happens, or what is the tax liability where none or insufficient tax has been paid by the expatriate?
Well, let me
okay, sorry, you can go ahead, apply. Go ahead, please.
Okay, fine. I can take the first part, you will take the second part. Is the expatriate earning less than minimum wage? That's what you have provision in the new Finance Act. So once you have less than minimum wage, okay, it's free.
Is that possible? That you have less than
fine. For you to bring an expatriate and pay him less than minimum wage is the question that the questioner will answer himself. You get it?
Okay.
Thank you. So continue.
Thank you. So what my colleague was just trying to say there now is that we have what we call a provision. You can call it best of judgment. Now, if you are an expatriate and you say you have earned minimum lower than minimum tax, of course, the best of judgment will tell us that there's no way you could have left your country to come to Nigeria to come and earn minimum wage. And so the tax authority might use different other means of getting what should be your income. In some instances, we have instances where some people, expatriates, direct their employer to pay their income directly to their home country. So, and we have exchange of information provision with other countries that may allow the tax authority to get such information to trace where those income has been paid for the purpose of bringing that person to tax in Nigeria. Then the last question is about somebody that has failed, the liability of somebody that has failed to pay his tax. As I said earlier, the first thing I said is that if you have failed to pay your tax, we have different procedures of number one, investigating or determining whether you are paid your appropriate tax. The law allows or require everybody to file what is called self-assessment returns. So every year, a person is expected to file his returns and pay his tax. Then further, the tax authority go ahead and conduct, we have monitoring, we have desk examination, we have audits, and we have investigation. All these processes can help the tax authority to determine whether there are some income that have been left out that have not been declared for tax purposes. And as I said earlier, we can also go through exchange of information process to determine that. Then the authority also have enormous powers, for example, to get information. we can go to offices, companies, to retrieve records and to get those information. Now, when it has now been determined, we have been able to trace or get these records, and it has been determined that this person has not paid appropriate tax. There are penalties in the law. So the law provides for penalties. The law also provides for interest, because now you have been using government money to trade. If, for example, you were supposed to pay a tax in 2020, you did not pay it, and we discover in 2021 or 2022, those periods that you have kept the money in the because we assume that you have been trading with the money, that's why you didn't bring it to the tax authority. So those periods, the law requires the tax authority to compute interest. So that interest will be computed with penalty, will be added to the actual tax liability that the taxpayer will pay. So the taxpayer will pay his tax, the tax that is supposed to be paid penalty, and pay interest. And lastly, there's also provision in the tax law that allow the tax authority to charge the person to court and convict the person. So if you fail to pay your tax, you evade tax, you can actually be convicted of crime. And we all know the implication of conviction. If anybody is convicted in Nigeria, that person cannot hold any public office, for example, in Nigeria. And there are so many privileges and so many things that person cannot enjoy. So it's not a good thing for a taxpayer to wait till he's charged to court and convicted for tax crime. Thank you.
Okay, so you pay interest on the unpaid tax, and you also pay penalty. That will amount to double jeopardy in law, if you ask me.
Complied. Complied to avoid it.
Okay, so the last question will be put to you directly as a taxman now. So after all these investigations, using the enormous resources at your behest, and an expatriate is able to prove his actual income with valid documents, which, so with the revenue, or will you accept the expatriate's actual income as the basis of assessment, even where it is lesser than the deemed income that you are, as a revenue man, determined?
Well,
even if it's lesser than the deemed income, even less than the minimum income, will you accept it?
Well, taxation is low. You may like it, you may not like it. Okay? You are just going to apply the way the law is. If you can prove that you have, with all your evidence and fact, that he is not taxable, then you can allow him to go. But there is a provision of 1% minimum tax in the personal income tax law. So it's another provision that we have finished all your investigation, all what you are doing to confirm that, applied 1%. So that's what I'm saying, is law. It may not, that it's just the law. And then if you look at it, that's what we are saying. The expatriate may be resident, maybe non-resident. The domestic law we have in Nigeria is non-discriminatory. It does not distinguish between either you are black, you are white, you are coming from different. It's just a criteria. Did you belong to resident? Did you belong to non-resident? What's the provision of the law? So it's based on facts, and you have established all this, and you cannot apply it for personal income. You can apply the rate from 7% to 24%. So it's not earning 300 to 3.2 and above. Then you can apply the 1% minimum tax. Once it's not below the minimum wage. That's another criteria there. So that's you can just give him the way the law provided for him. I think that's when it's clear.
All right. So thank you very much. Thank you very much, Kende and Ablai, for the valuable insights and the responses to the questions. You all agree with me and my fellow participants that this has been an insightful session, and we have learned a lot on expatriate transition and the application of residency rule, given the restrictions on travel and other limitations imposed by the COVID. We are happy that we have subject matter specialists attending to these issues, and we are quite excited at the level of coverage which they have provided on these topical matters. We are grateful to the panelists, Dr. Yuri, Kehinde, Abdullahi. We are quite grateful, and we hope that when next we knock on your door, we will open and also because it's part of the outreach, educating Nigerians on what their tax responsibilities are. I hope that you will welcome us when next we call on you. So for the participants and to enable us to continuously provide training services that meet the demands of the times, we require you please to fill the feedback forms that will be sent to you. It shouldn't take more than a minute to fill those forms, so I can get your feedback on how this training went and also your expectations for future trainings. This will help us to plan for those trainings. We enjoin the participants to continue to follow us on our social media handles at DCSL Nigeria, Instagram, YouTube, and Facebook, LinkedIn, and Twitter soon, and to also ask you to look forward on those platforms for official events, which we will continue to publish on our social media handles. We thank you all for participating. We are excited. We thank our presenter, Dr. Yuri. We thank Kehinde. We thank Abdullahi and DCSL management for putting this together. For our participants for taking our time to attend, we are most grateful. We thank you. We'll ask that you enjoy the rest of your day. So it's a wrap. We'll be signing out now. Thank you very much.
Thank you.
Thank you.
Thank you.
Thank you.
Thank you. Bye.